Okay, so it is May 7th, 2026, and I am looking at a quarter where a company boosted its revenue 16%, but its official net income literally just fell off a cliff, down 75%. You are listening to Earnings Unscripted, where we try to make sense of what just happened. Today, we are looking at Canadian Natural Resources, ticker CNQ, and their first quarter 2026 results. So, Miro, how do you explain a profit plunge that steep when the actual business is booming?
Well, you basically blame the accountants. Seriously. The headline GAAP net income is $1.35 billion, which, yes, it looks terrible next to last quarter's $5 billion. But remember, last quarter they had that massive one-time paper gain from the Athabasca swap we talked about. And this time, they booked a $644 million penalty on share-based compensation, largely just because their stock went up.
Oh, wow. That is a really rough way to be rewarded. Quick thing, though, before we dig into that penalty, just our standard reminder that this podcast is not financial advice. We are just sharing our personal market opinions here. But wait, the stock price actually hurts the reported earnings?
Yeah, exactly. Their share option liability is marked to market, so the share price was on this absolute tear all quarter, up something like 46.5%, which means they are forced to recognize huge non-cash liabilities against the bottom line. But if you ignore that accounting noise and look at adjusted net income, they actually soared 43% to $2.45 billion. Adjusted EPS came in at $1.17.
Okay, that makes so much more sense, especially because top-line revenue was incredibly strong. They brought in $12.4 billion, which was driven by, I assume, geopolitical tension just keeping oil prices elevated.
Right, that is a massive piece of it. They extract heavy oil and oil sands bitumen, and the realized price for crude jumped 18% sequentially to over $76 a barrel. The underlying cash generation is just a machine right now. Operating cash flow was solid at $3.28 billion, though interestingly, the market kind of shrugged at the print today.
Right. The earnings day reaction was... honestly, it was totally uninspired. After that massive quarter-long run, it basically gapped down at the open. It did claw back a bit intraday, but still closed down about 1.4% at 44.70, which is weird considering what they're doing on the operations side. Did you see the note on the Jackfish site?
Oh, yeah. The facility hacking, that was brilliant because they're stuck in this regulatory limbo and cannot easily build new megaprojects. Their engineers just went in and tweaked the internal plumbing of their existing assets.
It is wild. Jackfish is built, on paper, to handle a maximum of 120,000 barrels a day, but they went in and optimized pipeline interconnects and debottlenecked the system, basically wringing blood from a stone.
Exactly. And it's working perfectly. They were reliably pushing 134,000 barrels a day out of that site in Q1. They beat nameplate capacity by 14,000 barrels a day. That's essentially adding millions of dollars in product every single week just by outsmarting their own hardware limits.
I love a good physical engineering win like that. But clearly there's a bigger story here about why they're forced to hack their own pipes instead of just building new ones. Management is essentially keeping their massive growth projects parked and using the cash to play a very aggressive game with their balance sheet. All right, let's get into the details on that.
Yeah, aggressive is exactly the right word. Because if you read the actual text, the capital allocation plan here is basically, it is a politically motivated capital strike. That is what we are looking at.
Oh, wow. Okay, a strike? You mean the fact that Pike 2 and the Jackfish expansions are just, sitting there on ice?
Exactly. I mean, they have these massive long-term oil sands projects ready to go, tens of thousands of barrels a day in potential capacity, but management flat out refuses to pull the trigger. You look at the transcript, and Scott Stoth, the president, he just openly points the finger at the Canadian government. He said, and this is pretty direct, over a very long period of time of a decade or so in Canada, we have not had the environment regulatory-wise to be able to grow volumes.
Right, because they're waiting on this MOU, that memorandum of understanding about the emissions cap and the new fiscal framework.
Yes, until they get absolute certainty on the taxes and the emissions rules, that money stays locked away. They are just not going to build.
And honestly, you can't really blame them, especially with the other risk they buried in the filings this quarter, the Bill C-59 amendment stuff. Did you catch that?
The greenwashing litigation piece, yeah, I saw that. That is quite a mess.
It's fascinating because on one hand, the government desperately wants them to cut emissions, but Canada just passed these amendments to the Competition Act that basically expose companies to huge financial penalties from private lawsuits if they try to market their environmental progress. So they're effectively terrified to even talk about going green.
Right. It's a massive legal trap. And frankly, it just reinforces the whole strategy of playing defense. So if you're CNQ and the government says, hey, we might tax your emissions, we will definitely cap your growth. And by the way, if you brag about your environmental pilots, somebody can sue you.
You just take your money and go home. Or I guess you give it to the shareholders?
Precisely. You return it. And that brings us to the balance sheet game you mentioned earlier, because it really operates like a video game level for these guys. Level 1, you get your net debt below $16 billion.
Which they actually just did right after Q1 closed. Sometime in April 2026, debt drops below $16 billion.
Right. So that flips the first switch. Suddenly, 75% of all free cash flow stops going to the balance sheet and goes straight out the door to owners. But the real magic number, the one Victor Darl, the CFO, kept teasing, is $13 billion.
The countdown to peak liquidity. I love that. Because what happens at $13 billion? They return literally everything?
Every single free dollar. 100% of free cash flow to shareholders. No more debt pay down. And Victor said on the call that the $13 billion target is approaching faster with increased free cash flow generation, which is why analysts were practically begging them on the call to lean into the balance sheet now, basically asking them to borrow a little against their equity to buy back more stock aggressively today.
But they refused, right? They are just rigidly sticking to the formula.
Totally rigid. Stotz said there is going to be lots of free cash flow in the second quarter, but they will not lean in. They are maintaining that exact 75% payout ratio until the math organically hits $13 billion. It is just completely robotic discipline.
Robotic, but highly effective. It kind of feels like they are running a giant cash incinerator in reverse, just printing money and rigidly dealing it out like a casino dealer.
Yeah, a casino dealer who absolutely hates the local mayor. That's the vibe.
That is exactly the vibe. Okay, so taking a step back here, where does this leave them heading into next quarter? Because obviously the cash machine is on, but those macro and regulatory forces are still looming.
Well, it leaves them, honestly, locked into this highly disciplined holding pattern. Management officially maintained their 2026 guidance across the board, so they are keeping that roughly $6 billion capital budget, holding production targets steady, and just letting the cash machine run. The absolute priority for next quarter is just relentlessly marching toward that $13 billion debt floor.
Right, because they outright told analysts on the call that they will not do any extra opportunistic buybacks until they organically hit that exact number, which is, kind of a wild level of restraint for an oil major swimming in cash.
It is. But I think the broader takeaway, the real thing to watch here, is how they tried to innovate their way out of that regulatory corner. They are running this new pilot test at Kirby North using butane instead of steam to extract the oil. And it is brilliant engineering. It reduces water usage and cuts greenhouse gases. Butane is just incredibly expensive. Stotz specifically said on the call that they have to focus on getting the cost right before they even think about scaling it.
So they have the physical technology to solve the environmental problem, but they have to wait and see if the accounting lets them use it. It is so perfectly on theme for them right now.
Yeah, it is world-class engineering trapped in a political waiting room. Until lawmakers give them fiscal certainty, CNQ simply will not move.
So essentially, do not hold your breath for any exciting new mega projects. Just expect a very disciplined, very lucrative factory slowly cashing out its owners.
Exactly. They are basically a high-yield savings account that happens to pull 1.5 million barrels of oil out of the ground every day.
I think that is the perfect note to leave it on. All right, that's going to do it for us today. Thanks for hanging out and making sense of the numbers with us.
Catch you next time.
And just a quick note before the mics turn off, if you want these earnings drops to just naturally show up in your feed, go ahead and follow the show. We actually generate this podcast with the help of AI tools to synthesize all those massive financial filings into a quick conversation. And we'd love to know how it's landing with you. You can toss us a ticker request or share some feedback by emailing earningsunscripted@datamadness.ca, or just grab the X link in the show notes.
See you after the next